All right, let's talk about a really powerful strategy for managing risk in your portfolio. It's called the financial collar, and honestly, it's a pretty clever way to protect your investments from those sudden market drops without having to shell out a ton of cash. By the time we're done here, you'll know exactly how it works.
You know the feeling, right? You're watching the market, things are looking a little shaky, and that little knot of anxiety starts to form in your stomach. You've got some great long-term holdings, but you can't help but worry that a big dip could just erase all those hard-earned gains. So the million-dollar question is always, what can you actually do about it?
And that, right there, leads us straight into the classic investor's dilemma. It's this constant balancing act, isn't it? Wanting to capture all that future growth, but also desperately needing to protect what you already have. So, let's put you in the driver's seat. Picture this. You absolutely believe in a stock for the long haul. You've done your homework, but the market's getting choppy and you're worried about a short-term nosedive. Selling just feels wrong. You could miss a huge rebound, not to mention the potential tax hit. So what are your options?
Well, a lot of people's first thought is to treat their stocks like any other valuable asset. You insure your house, you insure your car, why not insure your portfolio? And you know what? That's a great place to start. But it's not quite that simple.
In the world of finance, this insurance policy is called a protective put. What you're doing is buying an options contract that gives you the right to sell your stock at a specific pre-agreed price. So no matter how far the stock might fall, you essentially locked in a minimum price. It's your safety net.
And this chart shows you exactly what that looks like. See how the line goes flat on the left? That's your floor. It completely caps your potential loss. Meanwhile, on the right, your potential for profit is still unlimited. But, and this is a big but, there's a catch. That protection isn't free. You have to pay a premium for it, and that can get pricey. And here is the real problem. The cost of that insurance, that premium, tends to spike during volatile times, which is, of course, exactly when you feel like you need it the most. It can really start to eat into your overall returns. So it begs the question, is there a smarter way to pay for this protection? Yes, there is, and this is where the strategy gets really interesting. Enter the collar. It's an approach that gives you that same downside protection, but without that painful upfront cost. Let's see how it's done.
The core idea behind a collar is actually quite simple. What if you could pay for that protective put, your insurance, by selling something else? What if you could fund it by agreeing to give up some of your potential but totally uncertain future gains? It's a really strategic trade-off.
So how do you actually build a collar? It's basically a three-step recipe. First, you got to own the stock. Second, you do what we just talked about. You buy a put option to create that price floor. But then, and here's the magic trick, you sell a call option. This creates a price cap, and the money, the premium you get from selling it, helps pay for the put you just bought.
So we have these two parts, right? The floor that protects you and the cap that pays for it. Let's take a closer look at how these two pieces work together to put a collar around your stock's price.
Think of it like this. On one side of the equation, you have the floor. That's your put option. You pay a premium for it, and in return, you get that guaranteed minimum price. On the other side, you have the cap. That's the call option you sell. You receive a premium for it, and in exchange, you agree to a maximum selling price. And very often, the premium you get from the call can seriously reduce or sometimes even completely cover the cost of the put. The result is a profit and loss profile that looks like this. See, just like before, your downside is totally limited, but now your upside is capped too. Your potential outcomes are now locked inside this defined range. They're collared. This is the predictability you get in exchange for giving up those unlimited gains. This side-by-side comparison really makes the difference pop. On the left, with the protective put, you've got that safety net, but you're paying for the dream of infinite gains. On the right, with the collar, you get the same safety net, but you're also capping your gain. And by making that trade, you slash the cost of protection, sometimes even down to zero. Let's make this super concrete with some numbers. Let's say you own a stock that's trading at $50. You buy a put option at $45. That's your floor. Then, to help pay for it, you sell a call option at $55. That's your cap. Now, until those options expire, you know for a fact that your final sale price is going to be somewhere between $45 and $55. Your best and worst case scenarios are now completely defined. And this all brings us to the heart of the matter, the big trade-off. When you decide to use a collar, what you're really doing is making a conscious choice. You're choosing predictability over unlimited potential. You know, one source put it in a way I just love. A collar takes your return from the probable to the definite. Think about it. An unprotected stock
has a whole range of probable outcomes, from amazing to disastrous. A collar just narrows that down to a definite, known range. You're swapping a maybe for a for sure.
And this table from Fidelity just lays it out so clearly. Protective puts, high cost but unlimited upside. Collars, low cost but limited upside. But look at that last column. Both strategies are rated as most effective at doing the job of protecting your investment.
And this isn't just a neat idea in theory. Research really backs this up. One study on portfolio protection strategies actually found that the collar has one of the most attractive risk-reward profiles out there. It just performs really well because it does its job so efficiently. So, if you take just one thing away today, let it be this. A collar is a powerful tool for managing uncertainty. It lets you stay invested in the market, but it also lets you sleep a little better at night because you've taken this huge spectrum of what-ifs and squeezed it into a narrow, defined, and predictable result. And that really just leaves us with one last question, and this one is for you to ponder. When it comes to your own money and your own peace of mind, is that certainty, that predictable protection, worth trading away the dream of unlimited, shoot-for-the-moon returns? The answer to that probably says a lot about what kind of investor you are. Thanks so much for joining me.